Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Tom Hayes, Chairman and Managing Member at Great Hill Capital, for an update in where we are with the election, how markets are digesting it, and the areas that will outperform. Tom, it's great to see you. Welcome to Trade Talks.
Glad to be here, Jill. Thanks for having me.
And based on the initial reaction of the market, would you call the election outcome a have your cake and eat it too, or Goldilocks type of scenario?
No question. Like any good deal, Jill, no one walks away from the table perfectly happy, and that really is the sign of a good deal. In the case of the Democrats, they're certainly happy to have the leadership that they want in the executive branch. In the case of the Republicans, they're happy to retain the Senate. But from a stock market standpoint, I think the most important thing is that the biggest fear was an increase in the corporate tax rate, which would have gone up from 21 to 28% under a blue wave, which was the market consensus. And calculating that in terms of earnings, the S&P 500 is expected to earn about $167 a share for 2021. It had been estimated that if we increased the corporate tax rate by that magnitude, we would have lost $20 per share of earnings or thereabouts. And it would have been very, very difficult to offset that amount of loss, even if the stimulus package would have been much larger under a blue wave.
What sectors do you think will outperform, assuming Biden gets into the office?
Yeah, I think right now it's going to be a combination. So the first move sometimes is the wrong move. As we saw yesterday, we saw a huge bid in treasuries. We saw banks sell off materially, particularly regional banks. As the market has digested it in the last 24 hours, now we're seeing banks outperforming today, materials outperforming. Certainly tech is still getting a bid. It got the first bid yesterday. So yesterday, the playbook, the immediate response was to go back to what worked in the Obama administration, because it's a feeling that the Biden administration will be similar. And that was a meaningful bid into the FANG stocks, that the overweight market capitalization stocks that make up about 25% of the S&P weighting. And today it showed a sign of health as we got material broadening. Regional banks are up materially, almost 3%. Certainly tech is still up a bit less. Materials are actually leading the pack today. So this is really a sign of health that everything is going to continue to do well. And I think that's really just a function of having the gridlock, which we've seen for the last 100 years. The stock market actually performs best under a divided Congress, regardless of whether you have a Democrat president or a Republican president.
What are the four key bullish constants that you're looking at regardless of the outcome?
Yeah, I think that's the key point you hit on, Jill, because we know one thing is for sure: we are going to get stimulus soon. Whether that would have been $2 to $3 trillion under a blue wave, now it's probably still going to be $1 to $2 trillion under a divided Congress. So that's number one. Stimulus is coming. That's bullish. Number two, we know a vaccine is coming before the end of the year. This morning, the CEO of AstraZeneca was on saying so. A couple weeks ago, the CEO of Pfizer felt that they could go for emergency approval potentially before the end of the year as well. That is critical, and that will be the linchpin to see cyclicals start to perform in a more material way. We've been led by tech predominantly in the kind of stay-at-home economy. I think we're going to get a healthier market where more and more sectors are going to participate in a material way. That will be triggered by the vaccine and the winding down of coronavirus. Third thing you're going to see is now more states start to aggressively open over the next weeks and months, which will be a very constructive thing for GDP. And finally, we have the Fed meeting today, and they're going to remain accommodative. They're going to be the backstop, even if we have a little uncertainty in coming weeks, by keeping rates low and doing asset purchases as required. With mortgage-backed securities, treasuries, and potentially even corporate credit if required. So those four things, regardless of the outcome, are going to lead to potentially taking the market to new highs and moving things forward for the economy.
Let me push back just a bit on the vaccination thesis there. And I understand the market's a discounting mechanism and it is separate from the economy. It's separate what's happening on Main Street. But even with vaccine and therapeutic approvals, it still needs to be manufactured at mass scale and be accessible. It's not like here's a vaccine approval, a switch is going to go on and things go back to 2019. So while the market may price it in, it's still going to take time to trickle through Main Street, or at least to the consumer, for quite some time. And that's kind of where you see this divorce from what's happening in the market versus what's happening in real time.
Yeah, I think you hit the nail on the head, Jill. And the governments have really stepped up to fill that void that you're pointing to. If you think about, the IMF is expecting a negative 4.4% contraction of GDP on a global basis. However, global governments have now produced over $12 trillion of fiscal stimulus, and central banks have produced over $7.5 trillion of additional liquidity, and we'll probably get another $1 to $2 trillion in fiscal stimulus in the US in coming months. So when you look at that, irrespective of the vaccine and treatments and how quickly they get out, you have basically that $3.6 trillion contraction. Think of that as the pothole. We have over $20 trillion of asphalt that's applied to that pothole. And that's why what you're going to see is, as slowly more people become vaccinated, slowly treatments come out, people get back to normal, that money is going to pick up velocity. And that's going to be very, very bullish, not only for the stock market, but for the general economy as the velocity picks up.
All right, Tom, appreciate the insight. Thanks for joining us on Trade Talks.
Thanks for having me, Jill.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.